Hello and welcome to 5 Year Club video number 353. What? Never gets old. Today's stock market behavior, which is like, why am I even talking about this? It's because I don't have any ideas. That's why. All right. So this is from Market Watch, obviously. It's just a picture of the article. The Dow just staged a nearly 900-point turnaround in frenetic Thursday action. Yeah, getting some action on Thursday. The Dow Jones Industrial Average booked a dramatic reversal, ending higher after trading sharply lower on the session Thursday. The Dow DJIA was plus 1.14%, closed 1.1%, or 258 points at 23,136 on a preliminary basis after being down by as many as 611 points, or 2.7% at session lows. So in the middle of the day, Lewis was reading articles like Dow down 600 points, or whatever. And then at the end it was like, oh, no, it's not. It's cool. The day's trade follows a historic surge for the Dow that saw it rally by more than 1,000 points, marking the largest single-session point gain in history. The S&P 500 index, SPX, plus 0.86%, also turned positive on the day, ending up 0.9% at 2,488. The NASDAQ Composite Index was plus 0.38, eked out a modest gain, rising 0.4% to finish at 6,579 based on the preliminary closing levels. The swings occurred within the final half hour of trading in a seesaw day. On Wednesday, the Dow ended with a gain of 1,086 points, or 5%, at 22,878. The S&P 500 soared 5% to end at 2,467. The NASDAQ rose 5.8% to 6,554. All right, so what was today? Today was doom, 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 doom. And then apparently in the last half an hour, something happened where someone decided to buy a bunch of stock or obviously not a single person, right? I guess it's theoretically possible, but, something happened in the last half hour trading. I don't know what it was. And enough people decided to purchase stock that the prices rose back up, and all of the lower stuff earlier in the day was just a bunch of bull crap. And it was actually an up day at the end of the day. So a very volatile day. And that reminded me of this concept that I've learned where, because it went like this. Well, I don't know which way this is going to show. I think it's this way. So it was like something like that, right? It's a smiley face. And it reminded me that if you buy throughout a smiley face, if you buy on the way down, if you buy on the way up, you make more money than if it was just flat. Especially with the way that stock drops typically work, right? Because generally speaking, right, if you start up here, and generally speaking, it doesn't slowly go down and then spike up. That's not usually the way that it works. Generally speaking, if you look at historically the way the stock market usually operates, you get like a big wave of fear, okay, and there's a big drop that's very sudden. That's what we've seen in the last 3 months, is a very sudden, relatively speaking, 20% drop in the stock market. And then it slowly goes up, over the course of the next 18 months, 2 years, 5 years, whatever it is. So I found an article that discusses buying into a market crash. So here's an article. Ooh, that's trippy. Here's the best way to buy stocks if you fear a market crash, which I think is something that everybody is thinking about right now. Everyone is paying attention. And this is from September 25th, 2014. Investing in the stock market can be extremely frustrating for those who look back on the big rally they missed, and nerve-wracking for those who believe they may be putting money into the market at the top. The S&P 500 has roared almost 200% from its March 9th, 2009 low close of 676 to its high of 2011 on September 18th. With today's big market sell-off, some are worrying that we've seen the market peak. right? And guys, obviously, they're talking about only 2011. Like, we've clearly surpassed 2014 levels. Some are worrying that we've seen the market peak. This obviously would make investors extremely hesitant to buy stocks for fear of a big decline or perhaps a crash. However, obsessing over this risk could lead to analysis paralysis because you can never know with certainty if the market will indeed crash. And those who constantly stay out of the market for fear of losing money will miss out on some of the best opportunities to buy. Fortunately, there is a very basic investing strategy that can save investors from losing too much hair as they make the decision to buy stocks. It's called dollar cost averaging. There is a correct way to buy stocks as the market is crashing. The stock market is great for investors who have the benefit of long-term investing horizons. It's also better suited for investors who aren't concerned about perfect timing market tops and bottoms. Having said that, taking a long-term view is good for investors worried that they may be buying at the top of the market. A classic strategy called dollar cost averaging can help reduce risks surrounding an asset falling in price. The concept is straightforward. You invest a fixed amount of money in an asset once every fixed time period. If the asset's price drops, you will be getting more shares of the asset for the same amount of money. And so if and when the price recovers, you will have spent less per share on average than if you had bought the shares at their peak, pre-fall price. Dollar cost averaging isn't about losing money as the stock market falls. It's about buying increasing amounts of shares at cheaper prices, which means bigger returns during the rally. How dollar cost averaging worked brilliantly during the last crash. To see this in action, we came up with a simplified thought experiment. We considered what would have happened to an investor jumping into the stock market at the last peak, October 2007. This was arguably the worst time to buy. Our hypothetical investor puts $50 into a S&P 500 index fund at the start of every month starting in October 2007, the last stock market peak before the beginning of the Great Recession. Here's what happened to the S&P 500 starting at that peak. The index dropped more or less steadily until the worst moments of the financial crisis in fall 2008, causing the full-on crash, and only began to turn around in March 2009. Let's look at this, right? So this is the S&P 500 throughout this time period. We're beginning in October 2007. We hit a low around February, March of 2009, and then it steadily increases from there. The key to our investors' experiment is that they are staying consistent. No matter how stock prices move, they will always put $50 every month into the index fund. Based on changes in the value of the S&P 500 index, we calculated our investors' price return less the $50 monthly cost. The value of our investors' portfolio as of September 1, 2014 is $6,563. So that's the value like as of today. If they instead had taken their $50 each month and held it as cash, they would have just $4,200. All right, so a little quick math, about $2,300 difference between these two behaviors. Staying out of the stock market, $4,200. Buying at the peak, $6,500. You came out fine. So the price return on this investment, even though they started at the peak just before the market started to go downhill, is $2,363. Yep, this is a respectable 56% return. That averages out to about a 6.5% annual rate of return. To get another perspective on this, here is the percent gain or loss compared to taking $50 each month and holding it as cash. So you can see that when you buy going into a crash, obviously you're going to lose some money, right? But crashes don't last all that long. I mean, the Great Recession was even a great recession, but the stock crash part of that, it went down fairly quickly. And over the course of 7 years, right, most of that 7 years is going up, and so you're making money. That explains why you come out $2,300 ahead by investing even if you start at the peak. Things start out looking pretty dire as the economy fell into its deep recession through mid-2009 with the S&P 500 reaching a minimum in March of that year. At the lowest point for our investor at the start of February 2009, she would be down about 36%. She would be down about 36%. So if you're in the stock market, you need to be able to handle looking at your portfolio and being down 36% and saying, I'm going to stay in because the evidence says that I will probably make money if I stay in, right? This video number 353 from Lewis is not guaranteeing that this is going to work. It's just an argument that the evidence is in your favor and that we should act in ways that are based on evidence. Because human beings are often overly risk-averse, our hypothetical investor might have been tempted to abandon their investment plans during the bad months. That is, they might look at this chart and panic about the drop. But if our investor sticks with their plan and keeps putting $50 in every month, even through the dark times, once the market bounces back, they end up doing quite well. Here's why you never hear about this. Unfortunately, dollar cost averaging isn't sexy. It's much sexier to sell at the top and buy at the bottom. Obviously, your returns would be much higher if you win the stock market lottery by perfectly timing the tops and bottoms of the market. However, almost everyone who tries to do this will find themselves losing money and lots of it. If you are investing for the long haul and can hang on through watching your portfolio's value drop temporarily in bad times, starting to invest in stocks even near a peak may not be as terrifying as it looks. The market has always bounced back sooner or later, so if you can hold until that later, don't panic. All right? So yeah, 20% drop in the stock market, stocks are 20% off. Well, that is it for video number 353. Hope you enjoyed it, and I hope you will think about setting aside money and saving money so that you can invest into this dip so that as it comes back, you have substantial holdings and you will enjoy them as they rise in value without any effort from you. And you can look at personal capital and see, that $1,000 of net worth increase happened for you in a month without you lifting a finger. But to do it, you have to be willing to put the money in. You have to be willing to save the money. You have to be willing to buy into the market even after you see it fall. You have to be able to buy into the market even when you suspect it might fall more. So obviously, I don't want all your money to be in the market. I want you to have a healthy emergency fund. I want you to have low expenses. I want you to make a plan for what happens in the worst case scenario. But there's a limit to how much emergency fund you need, right? The typical market crash lasts 18 months. Recessions can last longer, but they typically are like 2 years. So you really don't need more than 2 years of savings. And if you think you can get a job after looking for 3 or 6 months, then you don't need more than 3 or 6 months of savings. And beyond that, you need to have your money working for you, because at the end of a 30-year retirement plan, 90% of the money is from investment gains if you invest. If you don't invest at all, you're going to miss out on 90% of your retirement money, and that would be a bummer. And so we have to act based on evidence. We have to stay calm. We have to stay invested if we want to follow the buy and hold strategy, which time and time again beats other strategies. And on volatile days like this, we have to remind ourselves kind of what's real, what's happened in the long run, and what's just some bullshit that happened on one day. No one's going to remember. Nobody is going to remember December 27th, 2018 in the future. Nobody is going to remember that it dropped by 600 points and then came back up by 800 points. No one's going to remember. No one's going to care. Which, it reminds me that next year I'm going to be making videos, but not every day. And I want next year to have a different focus for me. That's cool. Like, you need to do different things in your life. But one thing is, what if I didn't look at my portfolio, or I didn't look at the stock market at all for a month? What impact would that have on my emotions, on my outlook? I don't know. I think it's worth trying. I don't think that I obsess over the market every day, but I do think that it's kind of like an unhealthy scorecard, if that makes sense. It's like my football team. And I'm like, come on. And like my football team hasn't won very many games in the last 3 months, clearly. So it's like, do I really need to be suffering from that, from their performance? I mean, on average, the stock market's going to go up. So on average, if you're invested, you should be like, yeah. But if we dislike losses so much more than we like gains, even if it's falling a minority of the time, it might not have a good emotional benefit. And frankly, a lot of the like most well-off people I know are like, nah, I don't look at my portfolio. I don't care. They focus on something else. So that's just a little bit of side note. All right. Well, thank you for joining me for video 353. Hope you enjoyed it, and have a fabulous evening.